Welcome, everybody, to another episode of the Ag View Pitch. We're heading into a new week, the first week of December, the 2nd through the 6th, new marketing week for December, and we're getting that last month of the year. We have with us today Jarod Creed. Jarod, how's it going?
It's going well. I'd say fall. Did fall ever come around, or we just have a long autumn and go straight to winter? It was
Yeah.
not fun walking outside in the -0 wind chills here this morning.
Yeah, I think that's the other thing that's interesting. I think harvest went pretty good. It was so dry in a lot of areas, and then it went from dry to wet in areas, and a lot of guys didn't get as much of the fall work done in some of these areas as they were hoping. I might start there too. Do you think that could or would possibly influence some of the acre mix a little bit, or do you think that's those guys will still notch the corn in?
There can be an impact for next spring's acres, Chris. I don't know if I'd be willing to hang my hat on that at this point in time. There's still a little bit of talk about some possible field work here in the middle of December as well, based upon the current forecast. It would seem that the most challenged field work this fall would be tied to no-till corn on corn and anhydrous application. That's probably the most consistent conversation that I've heard. Any till ground, not really that many issues. Seemed like manure was maybe a little bit of a battle, but I would I would venture to say it's a little premature to suggest that that can impact some acres next spring. Maybe the wild card there would be if we actually do lock up any type of field work between now and this next spring, what
Mhm.
prices of inputs possibly do between now and then. You start talking about anhydrous being maybe over $1,000 a ton, and taking a glance at what grain prices are at that point in time, maybe that could persuade a few acres. But to talk out about both sides of my mouth here, we would be, I don't know if we're done going up in corn possible area for next year at this point. So it's not like we're already talking about reducing acres. Maybe we're having a little bit tougher of a time gaining as many acres as we had the potential to do.
Mhm.
I mean, not to just dive in the next year, but if you wanted to split 178 million acres of corn and soybeans for next year right now, the market's basically telling us that be prepared for 95 million acres of corn or greater.
Mhm.
I don't know if we necessarily need that. I know we certainly don't need the soybeans. Maybe that's a little bit premature to say as well, depending on what happens the next 60 days in Brazil. At least the next 30 days doesn't look like it's a challenge whatsoever. But the market's sending a signal right now that we need to be geared up for the potential of a tremendous amount of corn next year.
Hmm. So I wanna come back to 25. I want to circle back to the here and now. So we talk field work and stuff. The other thing that's going on in the here and now, though, and then like I said, we'll get to 25, is the idea that there's a lot of unsold bushels, mostly of corn. I mean, there's guys that are sitting on soybeans here yet too. And with that corn inventory, and we're headed into um, the holiday season and the end of the year. And some people are going to need cash flow yet before the end of the year. And a lot of people will probably be selling that January timeframe. And there's where the pressure comes in. Talk a little bit about things that guys need to be aware of if they need to get some stuff priced yet in this year.
If you back the story up a couple of years, it's been the same old tune that we've seen the U.S. farmer run behind on selling pace for an extended period of time now. But there was a point on the front end of harvest that farmer selling actually picked up quite aggressively. I don't think that that caught them back up to normal, but since that selling subsided, it has subsided, as in next to nothing all over again. And arguably, the corn market hasn't necessarily suggested that the farmer needs to, the corn market hasn't given screaming opportunities to move a whole bunch of grain. I think you look at a lot of selling strategies of, okay, I've sold this price. I'm not going to sell that price again. I'm waiting for an additional higher price. And the market just hasn't presented that opportunity. All the while, we've had the risk of front loaded demand, and that has firmed up cash basis values across the countryside. I would err on the side of caution here that we've seen this happen in years past. I'm not so certain that the next 30 days, maybe 60 days, are going to present the best basis opportunities that we see for the balance of the year. And when I talk about basis opportunities specific to corn here, I'm not suggesting that basis values can't be dramatically higher next summer, but I'm talking about cash to cash, cash markets, delivery values. What does it take to get from point A to point B, especially on the cost to carry? And last year, we've seen the exact same thing happen that I'm afraid is going to happen here this year, is that the cash availability or the cash opportunities, I keep saying cash, but the cash market, board plus basis,
Right.
is arguably the best cash opportunity that the farmer has had since the second they put the crop in the ground. And I don't think that can be overlooked. Our insurance price was 466. We spent a lot of time between 450 and 475. And you look at historical off the combine basis values that you would have had an opportunity to sell during the growing season. And then you fast forward to today, the cash market is arguably in the top 10, 15 cents of what the farmers had an opportunity to do all year. So with all that said, market hasn't given opportunities. It's just been very stale, 20 to 30 cent range for the better part of 3 to 4 months now. And implied volatility, I know we talked about this last go around. Implied volatility is so cheap that the market's, in my opinion, begging the farmer, move your grain. And when you start thinking about what grain you have to move between now and the end of the year, it's not about how much cash do I need. Rather, I would encourage somebody to think about how much can I actually move. You
Yeah.
have all sorts of tools out there to keep a seat at the table. We've talked about that numerous times. And, not a suggestion, not a recommendation, all that hoopla, that you can have a seat at the table for another 90 days for less than a dime and not have to worry about the possible doldrums of the winter market taking the quick 20, 30 cents away from you.
Mm-hmm.
I don't know if it's any more complicated than that, Chris. Cash, about the highest it's been since the crop was put in the ground. I have reservations about the amount of movement that's going to have to happen after the first of the year, especially combined with the risk around the change in presidency and the potential policies coming our way. There should be a wall of corn that's going to have to move to the market over the next 90 days that'll put a lid on basis values for the rest of the year,
Mm-hmm.
rest of the marketing year, I should say.
And is that true for flat prices too? I'm going to blend the funds into this because the funds are long. Is there, what are some of the potential scenarios we can see?
We talk about the funds being long, but I would argue that they really just don't have a position. I mean, they have a very modest long, and they had a relatively sizable short position going into harvest, and their short covering really ramped up that first couple weeks of harvest. What we were talking about when the farmer was selling a bunch, the funds were buying, the farmer was selling. Flat price never really felt a big buying wave or a buying spree. And if anything, that is a wet blanket above us now that you have to find a significant rhyme or reason for funds to continue to buy in a sizable manner at a more aggressive pace than what the farmer is willing to sell it. And there's still a chance that long term here we could get back into an inflationary trade because of the potential policies coming our way.
Mm-hmm.
But if that inflation trade doesn't come around, what fundamental reason is out there today to be an owner of a reciprocal produced commodity such as corn, soybeans, and wheat?
Mm-hmm. So let's transition. You laid out a good segue there for the appointments that President-elect Trump is setting up on the ag side of things and for the Fed. I mean, there's a lot of moving parts there in conjunction with the stuff we just talked about. Any other things that you see there that growers need to be paying attention to from 30,000 foot view?
From a 30,000 foot view, I would suggest that the past comments, past practices, past bills introduced and such, there's a lot of headwinds for agriculture, specifically around biofuels. A couple months ago, it seemed like the soybean processor was very concerned about biofuel policies after the first of the year. and they significantly slowed down their bean purchasing going into the front end of harvest. And I don't think there's any reason to suggest that that concern has subsided. Rather, we do run at least a rhetoric maybe that gets spread out around the industry, perception versus reality type of component, the fear of reducing maybe some of these subsidies in the biofuel space, the fear of the Inflation Reduction Act, the IRA, going away, reallocating that money to something beyond anything in conjunction with agriculture. From, excuse me, from the administration choices to this point, there hasn't been anything that suggests there should be a friendly tune to agriculture based upon the upcoming policies. It's complete opposite. Now the market hasn't cared. Again, perception versus reality. We've had a few headlines, such as the talk of tariffs and such, and how do other countries retaliate or lack thereof against those tariffs. But nonetheless, you have to search really, really hard to find something supportive to commodity prices based upon the upcoming administration. And one other piece just to throw in there, just a little bit of a tinfoil hat opinion here. Last go around, when all these tariffs started to come around, maybe the U.S. farmer got a little spoiled with all of the funding provided from the U.S. government in response to those tariffs. This go around, does the administration have the same reasoning behind that? Are they, let's just rip a band-aid off here. Do they need to buy votes? Do they need to buy votes again? It maybe didn't work last go around because of the flip from a Republican back to a Democrat, but you're looking at a one-term presidency here. And I think we need to be a little mindful of that there might not be that same type of, for lack of better words, bailout component in there provided by the government based upon the decisions that they make on global economy, global trade with other countries. It's easy being wrapped around the axle in agriculture that tariffs this, tariffs that. It's all agriculture related. No, agriculture is such a very small piece of the pie there. It just happens to be one of the commodities that's greatly impacted by those decisions.
And it just happens to be the one that we're, as producers,
Yep.
100% in,
I would argue that your leading indicators right now around potential policies is just go flip around and take a look at multiple different currencies from the Russian ruble. Russian ruble had probably its wildest day ever on Wednesday. It traded 14% range, 14% range in just a matter of hours. The Brazilian real, as we record this, is now over six, traded up to a 6-1, which basically means $1 is 6 real. That's a favor to the Brazilian farmer. And you can look at the peso, you can look at the Canadian dollar, you can look at the euro. To a certain extent, you can look at what the dollar index and maybe even gold has done, that none of them give you a real warm and fuzzy feeling.
Mm-hmm. One thing that I've heard a number of pundits mention in the industry is that, if you look at what Trump did the first time around, on the second time around, we had MFP and some of the other funds that he argued that, the money that was being brought back to the country through tariffs would be redistributed back into the sectors where there was an impact. What's your take on that? I mean, what I'm telling guys right now, because we're obviously just getting into budgeting pretty heavily now. I'm telling people, don't put a penny of any government money anywhere yet. You better just figure out how the hell we're going to survive in the meantime. And if anything comes from heaven, that's great. But I think we need to make sure we figure out how to budget. I just wanted to get your 2 cents on that too.
Well, I don't know about all the MFP programs and everything, but I do think that there's a heightened chance here that within the extension of the Farm Bill, maybe you've talked to Paul Neiffer about this here recently. It'd be a good subject here when we get closer to the beginning of the year. But there's likely to be some premium subsidies provided back to the farmer, retroactive to 2024 for their crop insurance. You're likely to see a couple other subsidies get adjusted and coverage levels and such for some additional insurance products. It might not come in the form of direct cash to the producer, but it might come in the form of um, adjusted or enhanced program availability to the producer for more of like a disaster relief. Maybe that's even thinking about raising a reference price around Art County and PLC and such.
Mm-hmm.
But I don't think that any of that has enough meat on the bone to help offset or help alleviate current commodity prices versus the current input cost to grow that commodity.
Mm-hmm. That's one of the dilemmas that I've seen too, and I'm sure you've seen this, from the risk management side of your business, is the fact that the operations that are struggling sort of the most in general are the ones that yielded right at or about APH and didn't have a lot sold. That's the area, because it seems like from what I've seen anyway, and like I said, I'll get a lot smarter in another 3 months, but the ones I've seen that had a significant loss, generally speaking, because the market or the insurance did their marketing for them at at those higher levels, significantly higher than where we shook out, all of a sudden are sitting with a really strong financial balance sheet. Their earned equity position looks pretty strong. Conversely, the guys even that had really good yields, again, it comes right back to the marketing equation, part of the equation in the marketing. If they're 50% sold, that wasn't enough. I mean, with where these prices are at, to where, a lot of those guys would be lucky to break even, and the ones that are making out the best are the ones that didn't have a crop, it seems like.
You bring up a very valid point there that the last couple of years, to the producer's defense, it's been hard to be aggressive enough. Define what enough is. Well, arguably speaking, it was closer to insurance guaranteed bushels being forward marketed
Mm-hmm.
well before you even maybe even reached pollination. Maybe it was even before or as you were putting the crop in the ground and
May
such.
May time frame.
May. You're right. And what do you learn from that the last couple of years? I'm a little concerned, Chris, that I'm not trying to cast a bad opinion about the countryside here, but I think there is a really, really dumb and unwarranted sigh of relief out in the countryside for some reason right now that we moved past the election and we've had a little bit of bounce and market's not going anywhere, and we get lured into this belief that we've got some demand, the market's going to go higher, everything's going to be okay. Maybe we do have a bounce. We repeat the same issues that we had the last couple of years, but maybe not selling enough. I would make the argument, same as old crop as a new crop. Now's the time to be as aggressive as you possibly can. Now's the time to be aggressive to the point that it makes you nervous, but you have to understand the tools that you can use to achieve that.
Mm-hmm.
It's not the first 20 cents up or 20 cents down from where we presently are that's going to make or break the farm. It's the 50-cent risk lower that will break the farm. The 50-cent higher can make the farm. So
Mm-hmm.
let's call a spade a spade. We're going to farm. We kind of know what our rotation is going to be. We know margins are tight or negative. How much worse do I want to let it get? And not to project all the way out into February, but you just brought up a valid point of the insurance and the insurance product helping the farmer ultimately market the bushels that perhaps they didn't raise. Well, if they raise a normal crop and we maintain the current price that we're at, December 25 corn is at 430 as we record this. And if a producer's carrying an 85% policy, you've got no price protection until $3.65, assuming the insurance price is 430.
Mm-hmm.
The interesting piece about that is I would argue that the 65 cents of downside risk there is the exact same amount of upside that we actually need to talk about a break even. You
Right.
get the board price closer to 480 to 490 to 5 in historical basis values. There's more producers in the corn side needing above 450 cash to break even than there are below.
Mm-hmm.
And on the soybean side, I mean, stretch that number out as far as you need to go. I don't know, 10, 11, $12.
Mm-hmm.
It's to throw a dart there. But I think there just needs to be something learned from the last couple of years, and there's an opportunity to learn today that the tools that you have access to are quote unquote the cheapest they've been that you've had access to for years and years and years. And I don't want to hear it from the farmer. Options never work. Don't. Don't even go there. It has to be understood what you're trying to accomplish. And it needs to be the tool to allow you to be as aggressive as you probably need to be in the current environment.
Mm-hmm. And the insurance, your point with like Paul Neefer and the farm bill and some of the stuff that's coming on the insurance um, pricing and where some of that stuff's at, the value on a lot of those products just continually seems to get better. So, hopefully this administration continues down that path. But that's been a really good thing to kind of look at, because those insurance products are a massive safety net from what I've seen, especially if you need them. Those people that had the low yields and stuff, I mean, it actually put them in a profitable position. So, I mean, it's, you can justify, um, you know, investing 20, 30, $40 an acre or whatever, or even $50 an acre, but it's really hard to give up $300 an acre. That's what starts really screwing with your working capital position. So I think those are things that I would agree 100%. We're going to have to do more homework and be more cognizant of what our businesses need in terms of the management side of things and be planning, I think, more than ever. Um, you had mentioned the beans too. I want to bring this up because you made a comment and I just wanted to, from what I'm seeing on the soybean side of things, I mean, most of our guys are in that $12 range to justify planting beans that they're going to need, unless I mean, the fastest way to lower that is increase yield. But a lot of these guys are at kind of yield. I wouldn't call them yield plateaus, but it just seems like, at least from my observation, I just wonder if you're seeing anything different, that the soybeans are harder to get that to capture that gain than it seems like it is with corn and even wheat in some areas where the wheat is actually working even better than the soybeans. Are any comments on that? Are you seeing that same thing, or is it
Yeah,
just,
we see that every year across all of our clientele. I think there's
is it more enhanced
maybe
now
a,
though this year? I mean, just, and maybe it's because that corn bean ratio is kind of sucky right now, but it just seems,
well, I like to just think about I'm going to spend X amount of dollars per acre instead of going down a path of what's my break even price per bushel, just because of having that 10 bushel range on that yield.
yeah,
Um, I like to just think about total cost per acre and I divide that by current price. And I'm honest with myself if I can actually yield that.
right.
And then I look at what can I actually yield and I compare that versus the cost and compare that same type of mechanic on the corn side. And very, very rarely does it actually suggest a situation that, hey, you might be better off planting beans in this case. We have a very, very limited uh, group of individuals that it actually works to their favor on more beans than corn. And that's a little bit geographic, but I would argue that it's more so, I could be blatantly wrong on this, but it's more so geared to fertility history around manure than anything.
Yeah, that's a portion of it. I would agree. The other thing I think too is, there's people that are growing, non-GMO or stuff like that. I mean, there, if you can get some premiums and stuff, then the beans kind of seem to work. But it seems like without the premium on the marketing side, and then you're still giving up some yield in almost every case from what I've seen. It's variable on how much you're giving up, and it also depends on if you're in a geographic area, to your point, where beans do yield really good. I mean, there's some pockets of the country where they can kick out 80 bushel beans almost every year, 80 to 90, and then that kind of works. But you get to where you're growing 50 bushel beans, it's just pretty hard to make it work. Even if you're in a low land cost environment and everything, it just makes that margin that much tighter.
It's discouraging to have the conversation around what loses me the
At
least.
least, right?
And I think oftentimes that conversation goes down the wrong path of, well, I'm spending less amount of dollars an acre on
Yeah,
soybeans,
yeah,
but
that's a
it's more about
fallacy,
what the conversion factor is.
right?
So my point there is you probably have seen a uh, a higher level of trend adjusted APHs build on corn than what you have seen on soybeans, naturally impacting the dollars that you can safely insure. And
Mm-hmm.
then when you start thinking about worst case, best case, especially worst case on this, I need to have that in the back of my mind that worst case, I lose $100 an acre in corn. Worst case, I lose $300 an acre in soybeans.
Mm-hmm. Yeah, the biggest dilemma I see right now with, if somebody's sitting here listening to this and thinking, yeah, I could add corn acres, but I have a logistical issue, I have storage
Yep.
issues, I have all of these other, and in some cases there's agronomic issues. Typically it's logistical and it's labor and it's resources. I think some of us are going to have to maybe start thinking about how do we adjust for those logistical needs or something too, because you do the math and like you said, sometimes the fallacy is, well, it's going to cost me a lot less to just stay the same way. And the change is hard, but sometimes, making some shifts incrementally, you don't have to like change everything all in one year, but incrementally, and geographically again too. I mean, this isn't the case for every area, but there's pockets that we see that if you could just incrementally adjust these acre swings and stuff, it has a direct impact on the bottom line. But
Well, it's just like I think it was Roosevelt, right? The farming's awful easy when your plow's a pencil and such.
yeah,
So I get it. I joke with our clients that it's easy for me to sit here and say this behind a computer screen, but I'm just telling you how the numbers shape
yeah,
out.
right, yeah. There's a lot of practical implementation that occurs. It's easy to say, yeah, we should do this and should do that. So, last thing I want to hit on real quick is we've been sort of talking about 25 along the way and everything we've talked about. But if we do see some price strength in December or whatever, and obviously we would see it in that new crop and stuff too, what makes Jarod comfy and warm and fuzzy on having some sales made in 25 this early? Or are there anything that you're looking for? And I'm not asking for a price or anything. I'm just asking for some perspective for growers to be thinking about, because you got to, very few people have any 25 sold right now from what I'm seeing. There's some. I mean, I think our client averages like 7% on corn and like 6% on soybeans is kind of what I'm seeing. And there's people that are 70% sold and there's people with 0% sold and everywhere in between. But the total is like 7% from what I've seen so far. And like I said, I'll be smarter and maybe the percentage is quite a bit higher than that as I get out more. But in this first initial 20% of budgets that I've seen, that's kind of what I'm seeing. Comments.
I don't know if this will answer your question exactly how you want,
Yeah, I
but
want it
wait,
exact. I want your crystal ball. I want to know exactly. No, I'm kidding.
what makes me feel warm and fuzzy is knowing that we did what is in our control to avoid having to sit across the table from the producer 1 year from now and have a liquidation plan.
The producer or the banker?
Both.
Okay.
That's what's most important in my mind right now.
Mm-hmm.
Now, it still comes down to the producer that I just don't have this belief or the data to suggest that we're out there looking for how am I going to make money? 9 out of 10 farms are looking at how do I lose the least amount of money next year?
Right.
Now, there's a lot of different ways to unpack that. But if I look from 30,000 foot, I want to maintain working capital and or build it, and I want to retain my equity. If I can accomplish those two things and I can forecast that appropriately, I'm going to pull whatever levers I have access to make sure that those two don't get away from me.
Mm-hmm.
That's what makes me feel warm and fuzzy. It's not price related. It's not yield related. I'm looking at all times and in 100% clear fashion here or transparency, we have been aggressively marketed on 23 or 24 and 25 for an extensive period of time. You
Mm-hmm.
see our clients' books, you know that it does not mean that we do not have measures in place that if the market wants to go higher, we have a seat at the table.
Mm-hmm.
But from a 20,000 foot view instead of 30, is not going to let 450 corn turn into 350 corn, because I don't want to be in that situation of saying, okay, well, we went to 350. Now we need it to come back to four.
Mm-hmm.
What we need, what we want, I think are two different things. And easy again to sit here and say this behind a computer screen. Um, Personal living expenses are still a very hot topic from all the budgets that we see. I get it. Human nature. You make the money, you spend it. And it's hard to take a step back from that. But there's a point here where the rubber it sounds all doom and gloom here, Chris. And maybe we'll talk about this a little bit at your meeting here in a couple months in Florida. But it's just in an environment that don't let yourself be the one that's in the crosshairs. That's what makes me feel warm and fuzzy.
Mm-hmm.
And quite frankly, how do you accomplish that? You stay hedged the commodity that you grow on an annual basis. You leverage cheap implied volatility. Cheap implied volatility means that price insurance is the cheapest the farmer has had access to since probably early 2019.
Mm-hmm. I'd agree. Any other comments? I mean, last word.
My last comment, I'm going to go back to this makeup in the marketplace right now that I just don't want producers to be lulled to sleep in. This can backfire tremendously here. But Chris, how many times in your farming career have you seen the market just stay in this 5-7% range, and then magically we go from that range into a higher range without some type of catalyst to do it? Typically, if we stay in a long-term range and we go to a new range, it's going to be a lower range. Everybody gets their fill at the last price range that we were at. Now we're going to go to another lower range. And that's what I'm fearful of happening in the next 60 days. And I think there's some historical examples to go back and look at kind of how that unfolded. It's alarming already that you look at next year's corn, we're at contract lows.
Mm-hmm.
Next year's corn is at contract lows. And that's not an easy assumption for the average individual to know. I mean, every penny we go lower from here is just lower lows, lower lows. And I don't know what the world looks like with, a return to say $9 beans and $4 corn.
Mm-hmm.
And that's not asking that much. That's less than a 10% drop for each one of those commodities for next year. That's
Mm-hmm.
board price. That's not cash.
Mm-hmm. Yeah, I think what you're saying is there's a storm brewing potentially, and there's a big threat out there, and we just got to make sure we manage the threat, and and maybe leave the top side open using some mechanisms to do that, because you just never know what the weather's going to do. But I would agree 100%. In my 27 years of doing this, I've seen four complete cycles now, and we're in this cycle now, another one, and it seems like, I would agree, it seems like the lows come in lower than what you anticipate, and when you hit that first layer of lows, it hurts, and the pain maybe isn't really being felt yet until maybe next year, if we do stay in these levels and drift a little lower, because these levels here are loss levels for a lot of operations. On the other side, I want to end with something positive here. It always seems like to me, in 27 years of doing this and working with producers, those who can survive through these troughs, and you talk about gaining equity, but even if you're losing some equity, but it's manageable, you're not losing so much that you're burning your working capital down to zero, but you're navigating that and you're staying afloat. In my experience, what I've seen is that there's some opportunities to grow towards the end of that trough, because not everybody's going to make it through the trough, and there'll be some of these boats that will sink, and we pray for those people, and we're sorry about it and everything, but that's just a fact of life, that happens. It's happened in every cycle I've seen. And the
We're seeing
opportunities
that
to grow.
weekly.
Yeah, and the opportunities to grow are going to come with those, probably the people listening to this podcast. You're probably going to be the ones that are going to have that opportunity, but just be patient, and to your point, return to management, I mean, the banks all call it living expense. I call it return to management because there's a whole bunch of stuff in that bucket. It's not
Hmm.
just your draw, but it's your employee payments, it's your electric bills, it's all these other things that you have that your your credit card's automatically paying that you could go back in and look and say where am I wasting money? Where can I clean up some stuff? And that return to management category is a big one. And then to your point, stop spending. It's kind of like if you're digging a hole, stop digging, stop spending for a year or two and survive. And I think to me, that's the good news. And the good news is also, I always tell people, and I would want to leave people with this, we don't become better business people with $7 corn and, $18 soybeans. We become better business people with $10 soybeans and $4 corn. That's what makes us better business people. And because we have to focus on stuff. And Shay's it was funny. Shay told me about a year ago, he's like, get all these people calling on Profit Manager now. And I was like, because people are starting to realize they need to do their math because
Hmm.
wake up in the morning and it's easy for a couple of years. The banks are guilty of this too. The banks got lazy for a couple of years too. And
100%.
now all of a sudden they're going to be asking us for a whole bunch more information that they didn't ask for 2 years ago.
So, not to one up you here, but to your point, have you watched the show Landman yet?
No.
Okay. You can't take this line because I'm making claim of it right now for the
Okay.
presentation here in a month. There's a phrase in this that says it's about the oil business. Our business is one of constant crisis, interrupted by brief periods of intense success. I rewinded that like half a dozen times to listen to that. And it just echoes exactly what you just talked about.
Yeah. You need to have
So,
that in great big letters on one of your key slides at our
oh,
conference.
it's going to be the title of the presentation.
Awesome. Well, hey, you just
Just you
oh,
got to tag Landman to show in there.
Landman. So where do we watch that if people want to go to that and watch?
That'd be on Paramount, I believe. It's another Taylor Sheridan show.
And
It's good.
it's called what again? Or
Landman.
Landman. Okay, got it. Well, that'll give us something to watch over the next weekend or sometime. So, all right, really good advice and good perspective, and I take the advice as go watch Landman, and then everything else is perspective, right? It's like you said from the computer. It's we got to do some planning for sure. All right, Jared, thank you. Really appreciate your time again today, as usual.
Thanks, Chris.
All right, we'll get you back again soon. And if anybody has ideas or thoughts and things you want us to be covering, we're going to be able to do a little bit more of that this winter. It's kind of hard to do that in season when everybody's busy as heck. The other thing too is if you're not subscribed to 19 Minutes, please check that out. It's on Spotify. We have lots of good information. Jared's been a guest on that a couple of times too. We get into a lot of the specifics, a little bit more detail and a little bit deeper on stuff. If you're not on that, check out 19 Minutes on Spotify. With that said, also check us out on YouTube. And I never asked this, but make sure that you go in and like and subscribe that stuff. I never have asked that before, and we probably should start asking for that. So with that said, thanks everybody. We'll catch you again next time on the AgView Pitch.